Now let us move on. We just saw how to construct the payoff diagram. I've explained to you all. Now let's get into the main business. Covered calls and protective puts. Trading an option and the underlying asset. This combination is with one option, either with a call option and the underlying asset itself, or the protective put is where you buy or sell a put option and you buy or sell a stock itself. Let us see one by one. Okay, what do you mean by covered call? Covered a portfolio consists of a long position in the stock. That means you buy a stock plus a short position in the call option. You have sold a call option. If you sell a call option, if the stock price go up, you will be losing because you have to pay off the exercise or by the buyer. It's always good to also from time to time look at the buyer's perspective also, not only the seller's perspective. You have sold or short a position in the call option. As long as the prices are low, of course, the stock will give you a low loss. But if the stock price goes up above the strike price, then you have to pay off to the buyer of the short call option. The long stock position is a cover or to protect the investor from paying off on the short call if there is a sharp raise in the stock price. Wonderful. If the stock price raises sharply, let's say it was a bullish situation, the price had a very high volatility of going up, how do you pay off the short call? You have sold a call, and of course, the buyer will exercise. So, this is where you can sell a stock which you have, gain the profit, and pay the short call. So, you neutralize or you limit your loss. To implement a covered call, you write a call, okay, you write a call option on the stock and long the stock itself. Hence, it becomes a portfolio. It's a combination of one long stock and one short call. What is the objective of this? To increase the returns from holding the underlying stock in the market. Because if you are holding the stock as well as you sold a call on that stock, wonderful, the stock protects you. When the huge increase in the stock price, well, the stock will gain you a bigger profit. So if the view turns out to be correct and the price remain flat, the call premiums will cover up the returns from the holding of the stock. You don't need to sell the stock. If the prices has fallen, of course you are getting premium by selling the call. That will sustain you some profit, and you can roll on the stock to the next person later. You can retain the stock, and you can earn the premium because the buyer of that call is not going to exercise if the price is down. But the risk factor here is if the volatility turns out to be higher than anticipated, let's say a large swing in the upwards, large price swing to upwards, gains from the stock where you are making by selling the stock will be lost on the short call, or stock gets sold at a too low price, may not be able to sustain the loss also. But however, your loss is managed. A large price swing downwards, as I told you, option premium may be insufficient to comprehend the loss of the stock, but that is if you sell the stock. You can hold the stock. You're already holding the stock. You already bought the stock. You can use that as a supporting tool. When you can write another call option on that, you can write another call option, and you can be still holding the stock. This stock will be a supporting tool. To implement, right on the money and a short term. Okay, write a short call on the money or at the money. What do you mean by at the money? That is the strike and the current stock price is same. So at the money, okay. A short term, maybe 1 month option or 2 months option, not for too long. Such options is unlikely to be exercised. In which case, roll over to the next month, to the next option. If you're selling a 1 month option and the 1 month expires and the stock price has not gone up, you can hold the stock and the option won't be exercised. You have earned the premium. Wonderful, isn't it? You can hold the stock, still belongs to you, and the option is expired without being exercised. So the stock can be held to write another call option for next month. Hmm? Okay, how to do the payoff diagram for the covered call? Okay, to see all these, draw the net payoff diagram using my method. I told you my method from the beginning. How? First of all, first write the payoff function, assuming that it's a European call option. For your European call option, of course, the profit area is the ST comes from the stock itself. The ST gain, if the ST is gone up to the positive, then you are gaining the ST. Minus, as you have written call option, from the writer's perspective, it's a minus max, it's not a plus max. Minus max ST minus K. If the ST is very high, you have to pay the difference between the strike price and the ST. So if the ST can, this ST can provide you that money, and plus, of course, you've got a call premium earned. That's how this equation runs, because you might be wondering why there's ST minus max ST minus K into 0 into plus C plus C. This ST is from the stock because you're combining both now, the stock earnings as well as the option payment. So we're looking at the large possibilities of the option being exercised here. Okay, second, construct a table showing the values of the profit for different range of STs or different values of ST, where the ST can be variable, can be from 0 to any other extreme value. We're looking at where is your K. So there are only two possibilities here. Either the ST is below K or the ST is above K. If the ST is above K, the option get exercised. If the ST is below K, the option will be expired without exercising. So how do you tackle this? So you put a table like this. You see, one column will be if the ST is below K, another column is ST is above K. What happens? The profit function is if the ST is below K, you get the money from ST, the stock itself, plus the call options premium. The option won't be exercised, so you gain the premium. And if possibly the ST it might go in a negative, because if it is below, then if you have bought it at the money, then it might probably the ST is negative, plus you gain the call premium. I don't want to put a negative here because we don't know. ST is a variable; it can be any amount. Okay. While if the ST is above K, then there you are. K is the strike price which will be exercised. You will be gaining. You sold a call, right? When you sold a call option and they exercise it, when the ST is above K, you will receive K strike price because you have to sell to them at the strike price plus the call option premium. Well, you might be buying a higher ST spot stock and sell to them at K. But if you have the stock with you, you don't need to buy again. Well, it is a foregone thing. There's opportunity cost. You didn't sell it in the market. You have to sell to this fella by K, where you have received a premium for that. Hopefully, the premium can substantiate the loss there. Third, based on the table, draw the gross payoff diagram and then devise the net payoff diagram based on the premium. Let us see here. Look here. You have short a call. This is the dark dotted lines is the you have short the call. And you have bought the small dotted lines is the stock itself. You long the stock. The long stock, the stock price will be moving along the ST, and you have got a K around this price. I didn't put any numerical value here, just to show you the diagram. This is the K is the strike price. Okay, the call option which is sold will not be exercised until the ST reaches K. The minute the ST breaches the K or uh, the value of the strike price, then you will see slowly you will be going into the loss region for short call. But however, if the ST has breached the strike price, you need not to worry now here because you have the stock with you. Look at here, the profit function. Initially, the red line here, the difference here is the upward shifting of this is equal to the premium. This premium is keeping the profit there. So the loss in the stock value, which is below zero, is substantiated by the premium what you have received. So it is keep on going up, equal in parallel to the stock price. But as it reaches to the strike price, of course, your profit functions become neutralized. What it is? It is become neutralized. Why? Because you're going to use, that's why I draw a nice arrow here. You're going to take the profit from selling the stock and pay your short call losses. So the profit from the long stock, when you sell it, you're going to use proceeds going to be used to pay off the short call. So therefore, your profit functions become flattened here. Why? Because you are not losing anymore, or it is not coming down. It's flattened because it neutralizes. Can you get it? So this is the main idea of covered call. Look at it carefully. You don't need to memorize this diagram. Look at it, the functionality of it. Of course, you long a call, a long a stock, the stock price will go from positive to negative. Let's say this is the point where it is reaching zero. Above this is the positive price. When the ST reaches zero, that means this is where you bought it. This is your buying price of the stock. If the ST goes above these, slowly you are getting profit from the stock. But you have short a call at a high K here. So until this K, you are making profit here actually. This small triangle here is your profit region from the stock. But the minute the ST breaches the strike price, that is where your profit which you earn from this point, from the strike price point until anywhere up there, will be used to pay off your short call. Are you clear now? Okay. So option strategies, you look here, there are a few diagrams I put up here. There's one called A, B, C, D. There are 4 types here. Look at this first one. Long stock, short call, just what you saw in the earlier diagram. You have long a stock and short a call. So the profit will be like this. At the K, it will become flattened. Okay, B, structure B, that you have short a stock. You have short sale a stock. Okay, there's no physical. So let's say you sold it. When you sell a stock, when the price fall, you gain. Why? Because you're going to buy back at a cheaper price. And you long a call. So when you have long a call, you have paid premium here. If the stock price goes up, the call pays you. If the stock price goes down, the stock pays you. So if the ST goes up, the call pays you to cover up the loss in the stock. So therefore, the profit is neutralized here, loss is neutralized here. But in fact, if the ST falls below the K, you don't have to exercise the option. You have lost the premium. That's why you can see the red line is below the blue dotted lines. Why? Because this is the small loss in the premium. But anyway, you just ignore the option, what you have long, and you make profit in the short stock. You're going to buy it back at a cheaper price, right? Okay, the third proposition here, see, so you have a long stock. you have long stock, like same like A, you have a long stock, right? The dotted lines going from negative to positive is the long stock line, and you have long a put. You have bought a put. There you are. This is a clear insurance strategy. If the price goes up, you're not going to exercise the put. You make profit from the stock. If the price goes down, you lose it in the stock, but you're going to make that money in the short put. Long put. The put option will give you the money, right? You're going to take the money from the put option and pay or neutralize the loss in the stock. If you sell the stock cheap, so let's say you bought it as at K and the ST has gone below, you're going to substantially lose by selling the stock. But that loss will be covered by the profit which you make in the long put. Put pays you, stock takes the money away. So it is neutralized below that. The loss is flattened, while the upside potential is unlimited. And the last one, D, this is another proposition where you short stock, you sold a stock, same like B, but you also short a put. You short a put. When you short the put, if the price goes down, the put will be exercised. To pay the exercise amount by the buyer of this put, you sell the stock. You buy back the stock at a profit. You short sale the stock, you short the stock. If the price falls, you make money in the stock. You take the money from the stock and pays off for the short put. If the stock price goes up, the short put buyer, or the person who bought the put is not going to exercise. However, you're going to lose in your stock price. As the ST goes up, if you sell the stock or if you buy back the stock, you're going to lose. Normally in short sale, you have to buy back. There's a substantial loss there. That's why the rate graph goes down. Okay, can you understand that? Okay, now let us look at protective put. What you saw just now is a covered call. Now we are looking at protective put. This is a classic insurance strategy for using option. That is, this situation, you are holding the stock and concerned it may fall in value in the near future. So if the stock is going to go down, you're going to lose. You're going to neutralize it by buying a put. You buy a put option on this. If the stock price goes down, if you sell the stock, you're going to lose. But you're going to gain the money from the put option which you bought. So the strategy for protective put is long a stock and buy a put option on the same stock. Let us just jump to the next. Yeah, you see, you bought a stock, okay, and protected put is here. Oh my God, this is not a put. This is a yeah, there you are. You have bought a put there. K is here. You have long a stock. If the stock price goes up, wonderful. You see, it's at K. You have bought at the money. If the ST goes up, you will make money in the stock. But of course, you don't exercise the put. Substantial loss is there. That's why the graph shows the red line, the profit line is shifted to downwards. But if the stock price falls below K, you're going to lose by selling the share at a lower price than what you bought. But that loss is going to be subsidized by your long put. Put option is going to pay you. You use that to finance your loss in the long stock. Okay, let us go back here. So the protective put portfolio is long stock, long put option with a strike price K, typically out of money. Okay. Objective is to obtain protection against a downward shift in the market of the stock price in the market while retaining the upside potential. If the stock price goes up, wonderful, you make profit there. Of course, a little bit of loss in the premium what you paid for the put option. But if the price falls, if you don't have any protection, you will face a loss. But since you already bought a put on that, your loss is neutralized because the put option gain will finance the loss on the stock price. If the price falls sharply, the put provides downside protection. If the price raises, the long stock position gains. Hence, you obtain the best of the both worlds. If the stock price goes down, you have got a safety net, that is a put option. If the stock price goes up, yeah, you gain the profit. So that's what you want. Profit, yes, gains are there, very good. But loss, hey, I don't want the loss. So I put a safety net there. That is the put option. Isn't it nice? Now you learned already. So next time when you buy stock, make sure you also buy a put. But of course, the price goes down, you won't lose much. If the price goes up, you must be prepared to pay the premium as well. You already paid the premium actually when you buy the protection. Okay, cost is the put premium. Higher the strike provides greater protection but also costs more. Because if you set the strike price higher, that means for a put, even a little bit shift downwards of the price, the ST goes down a little bit, then you're going to exercise it. As anticipated, volatility increase. If the volatility increase, the put premium also will increase. That is the standard deviation of the stock itself. If you look at the standard deviation of the stock, if that's a very high standard deviation, then of course the put premium will be high. Premium is lost if the prices do not fall. The price goes up, of course you lose the premium. You won't be exercising the put, but you gain much in the stock itself. Okay, let's resume. So far you have seen all the type of combinations with one option and one stock, right? Well, the protective put, if you look at it, how to do or write the payoff diagram for a protective put. Following my method, I told you when you buy a stock and buy a put option, this is what we call protective put. First, write the payoff function. In this case, of course, the ST comes from the stock itself. If the stock price goes up, this will be positive. If the stock price goes down, the ST will be negative. Plus, since you are buying a put option, it is max of K minus ST. If it's a call option, then it's ST minus K. But in this case, K minus ST because ST is supposed to be lower than K in order to maximize the profit of a put option. And of course, you are buying the put, so it's a minus P put premium. Second, construct the payoff table. So there are only two possibilities here, as I told you. Either the ST is below K or the ST is above K. That's all. Not much of a big issue here. Where the ST stands at the maturity, that's the question. ST could be below K or the ST could be above K. Of course, being a put option buyer, you will prefer ST below K. So let's see the profit function here. Divide the lines, that this is the range of, the first column is the range of STs. If the ST is below K, what happens? The ST is above K, what happens? You make a 3-column here. Okay. If the ST is below K, you're going to exercise it at K and you have paid the premium. K minus P. Because K is positive, because you're going to exercise the call option, the put option. Right? Now, if the ST is above K, you are not going to exercise the option. ST will provide you the positive side of it. The ST is the stock price itself if you sell the stock, minus of course the premium. Okay, it's very simple as that. No need to worry too much. How do I write the table? Table comes from the basis of the function. When you know you're buying the stock, profit maximization of the stock is only ST. There is no premium to be paid if you're buying the stock. and you are buying a put option. That's why you have to pay some premium. But how to maximize the profit in the put option? It is K minus S. So you are getting both. If the price falls, you're going to lose in your ST. That's why we don't have the ST there. K will pay you minus the P. But if the price goes up, where you're not going to exercise the put option, so ST from the stock gives you the money, which is positive side. And of course, you adjust it with the premium you paid. Third, based on the table, draw a gross payoff diagram and the net payoff diagram in a single chart. There you are. There you are. First, you get where is the K, and you have bought a stock there at the K itself. It's at the money, and you have got a range of STs here, and you have got a put option. You have bought a put option. If the price is above K, of course, you gain money from the stock. You lose your premium only. You don't lose your money in the stock or the put. But if the stock price falls, your safety net to protect the falling of the stock price is the long put. The put option can be exercised and you take that profit and pay off your loss in the stock. That's why I show you the arrow there. Okay, you all understand now? Okay, let us look at how to use put options for a portfolio insurance concept. This has been happening really. This is a real life example. Let's say index options. Options written on stock indices such as S&P 500 or ASX 200, or even in Malaysia is KLCI 100. Okay, portfolio managers can buy index or put options. Index put option. You buy index put options to protect their portfolios from fall in the value or market declines. So you're managing a portfolio for your investors. Let's say in this hypothetical example, suppose you manage an index fund portfolio that has a value of 500,000. Various stocks, and let's say these stocks what you have in your portfolio mimics the index movement. Suppose the current index is 1000 points, there are points, no value yet, and a European put option exists on this index with each contract value on 100 times the index. That means each point here, you have 1000 points in the index, each point worth $100, which means that each index point is valued $100. So your portfolio is worth 500 times the index. That means you have got 500,000. Your index is 1,000. So you divide it by 1,000. It's 500 times your index. Okay. That is 500 times 100,000 equals 500,000. To obtain the insurance against the value of the portfolio dropping, let's say by 10%, see 500,000, if it drops by 10%, it will fall to 450,000. Let's say you want to make it as the floor. You want to protect it, it should not fall anymore. Or it should not fall any longer. You can tolerate up to $450,000 fall. Or you can tolerate a 10%, that is a $50,000 fall in your portfolio. You can't sustain any more losses. So how to protect that is to, over the next 3 months, simply buy 5, because 100 is each contract, right? 500. So buy 5 contracts of 3-month put options on the index with a strike price of 10% lower than that. Than the current index value. Current index value is 1000. You buy at 90% of it is 900. You buy the index 900. So you have set the strike price at 900 for these index points. If the price falls below, if the stock index falls below 900, you can exercise your put option. So to illustrate, consider the situation where the index drops to 880 in 3 months. The index has fallen below 900. That's below your K. That is minus 12%, while you have set your target at the K is 10% fall. This already breached to a 2% extra. Portfolio will be worth about how much now? 500,000 times 1 minus 12, or this is 100 minus 12, or 0.1, 1.0 minus 1.2, no, 0.12. Then it will be equal to 440,000. That is, you can calculate this. You have lost about 12%. It is going to 440,000. Where your low limit is 450,000. You have lost 10,000 more. Payoff from the options. Now, how are you going to gain the payoff from the options to substitute this $10,000 loss? Payoff from the options is 5 contracts times 900 minus 880. Okay, K was 900. Your ST now is 880 times 100 is the index points. So that equals to $10,000, bringing total value back to 450,000. However, it goes down. You can gain from the exercising the put option to gain it back to 450,000. So that is your low limit. So this is how we set a protective put here in the index option. So when you are managing a portfolio and you can't tolerate it to fall below 10% gap, then you buy the put option at that low 10% on the index. So we can construct any amount of questions from this and try it out. Okay, I stop here 1 minute before we go to spread.